want to welcome everybody to the Exit Planning Forum as we kick off this amazing discussion today around how to understand and design your exit planning options. I'm reminded of a quote by Peter Drucker, who is considered to be the godfather of management. It says, whenever you see a successful business, someone once made a courageous decision. And you see that is what exit planning and the exit planning forum is all about. It's supporting and empowering business owners because you promote a lot of the job growth in the country. You risk your capital, your time, your stress, your health, and we want to curate some of the best thinkers and minds to give you actionable advice and perspective to support you on your journey. And today I am joined by my good friend and brilliant thinker and phenomenal human being, Sarah Goodman of Eminence M&A Strategy. Sarah, welcome to the Exit Planning Forum.
Thank you so much, Eric. I'm gonna. I've told our colleagues in common that I just want to package you up and take you along as my personal cheerleader each day.
I'm excited to be here with you because I think you have some amazing insights to share, and we're just going to have a conversation and share with folks what should they be thinking about when they're understanding and designing their exit planning options. And just to kind of set the stage for everybody who's listening to this either right now live or in the replay, there are three phases of preparing for exit planning. There's before, about to, and afterwards. And each one of these has its own sets of nuances that, Sarah and myself can share with you. So Sarah, let's just get right into the conversation.
Let's dig in, let's do it.
What the heck is exit planning, and why should business owners care about it, and what are some of the issues they may face?
Wow. So I've got an hour to talk, right?
Yes, you do. And you need all hour just for that.
Yeah. So I would say that I think it's really great to start the conversation with what is exit planning. And something that I've talked about, I know that we've talked about, is exit planning is something that every business owner needs to do, because every business owner, 100% of business owners, are going to exit their business in some form or fashion. And what exit planning is preparing for that exit. And what I think happens, and the reason that so few business owners have an exit plan, is one, the reality that it's something that's coming is maybe not fully appreciated. It's always something that seems like, potentially can be done later. And the other big factor that I've really understood is people think about it as a single point in time action. Like, oh, I need to file my tax return for this year. That's an action that you need to take. And there's some preparation that you need to do. But once that tax return is filed, it's done. We're good to go. Exit planning, my other kind of analogy, I'm really big on analogies, is you have to think about the maintenance of that plan over time. Think about it like the maintenance of a vehicle or a home or an other substantial asset, which is what your business is. It's something that really requires kind of, continuous activity. And as your business changes and grows, your exit plan needs to kind of change and grow, and what the circumstances of your personal situation and your family might be. And so I think because it is a little bit more nebulous, we've got kind of two problems. Business owners kind of think about it as sort of a checkbox item, and it's so much more than that. So they either underestimate and don't have one because it's perceived as a single point in time task that can be put off to later, or they do understand, all the different components that go into it, and that seems too daunting and complex because so many things tie into exit planning, as you said. So sort of a long answer to what I think was a short question, but it's really important to start having that conversation. And when I speak with business owners and they're like, well, I've kind of talked about that with my CPA. Great. That's great. I mean, certainly I know that you take this approach as well. I'm not here to bark at anyone's tires about what you have and haven't done. It's more about making incremental process. There's, especially because it's a continuous activity, doing something is way better than nothing.
Yep.
And, kind of taking it down in bite-sized pieces is also really important because, you're running a business. You've got all the other ups and downs of your business and profit and employees and customers and all of the other things you have to navigate. So long answer, but it's really important. It's comprehensive. It touches just about every part of your personal business and family finances, your legacy. So it's really critical that you get started at some point.
Yeah, and I would add to what you're saying is we need to. I think what business owners get wrong and just business advisors as a whole is that we view exit planning as an event rather than a process. And exit planning is a business strategy. Exit planning is just good business for anybody that owns a business. You should not get into a business unless you know how you're going to get out of it. You need to understand what your nuances are associated with the business. And I think a lot of owners either one, practice avoidance, two, they think that they've already addressed it. So a lot of people think exit planning is, well, I sat down my estate planning attorney and I did my will, and something happens to me, my significant other is going to get the business, or I went out and I bought some insurance. Great. Those are components of things that you may want to think through, but that's not actually that's not an exit plan. That's not a succession plan. That's no plan at all. Those are, like you said, action items of a longer conversation and framework that needs to happen. So I think the hope is that people will understand that exit planning is business strategy and everybody should think about it. I mean, Stephen Covey said it best. Start with the end in mind, right? What do I want to have happen, right? And so when you think about exit planning, Sarah, and the work that you do as an M&A advisor, what are some of the exit options that you help clients consider, and what are some of the things that they should be considering?
Great. And I love that quote from Covey. And it is actually the approach that I try to take when I'm talking with someone. Sometimes there's the reason I start talking to a seller is either because there's been an organic inbound request. Someone has offered to buy them that they weren't expecting. Or, increasingly, I think that the sort of messaging of this kind of larger wave of baby boomers that are going to be transitioning their business in some form factor. We're having a lot of those conversations. And just as you said, it's really important to think about the end in mind. And I'd sort of caveat that with, I think this was in some of the marketing materials for this. It's really important to understand what you want for the future of your business and an exit, but it's also really important to determine all the different places, like what is within your arc of happiness. Because I talk to business owners all the time. Just, a few months ago, I had a call from a business owner that they had really been building this business with the intention of passing it down to their children. And over time, it became clear, they were kind of hoping that their kids were going to change their mind, but it became clear that that wasn't something that the kids were interested in. And so now this person is kind of on E as far as gas in the tank left to run the business, and, kind of staring down the barrel of, a process, an M&A process that they thought that they were going to be able to avoid. They thought this was going to be a visit to the family attorney and, that would be that. So again, a long answer to a short question. So I'll get to the point. There are a number of options at your disposal. Are you going to sell to your employees? That definitely requires a significant amount of planning. Are you going to sell to a particular employee? Maybe you're going to do kind of a what's called a management buyout, rather than the business being held on a fractional basis by your entire employee base. Your management team is going to buy you out. Maybe you're going to consider a majority buyout by a capital partner. Maybe you just want to kind of have a phrase for this is kind of an elevator deal. You're going to take some chips off the table. You're going to sell 40, 50, 60, 70% interest. And you've got kind of a buy-sell agreement over time, to kind of take you out. That way you still get to kind of run the company. You have some upside for the growth of the business. And then you get to kind of pull some of that liquidity to kind of secure your retirement and your goals. You can sell to a third party. You can sell to someone in your family. You can sell to a competitor. And something I think that's often overlooked is, an intentional, purposeful, planned drawdown and liquidation is sometimes the best way to go, depending on the size of your business and what your goals are and what may be going on. That's something that, I'd love to see strong businesses continue, to pass that baton to the next wave. But sometimes a liquidation is what's best for you. So I think all of those things, trying to understand the market, just think about the last, 12 to 24 months we've been through as a business economy, trying to anticipate that if that was your planned exit period, trying to navigate the perfect scenario, it's so difficult. Timing the market, Warren Buffett, all these people, these, experts in investing, they'll tell you that timing the market is either extremely difficult or, some will go so far as to say impossible. It's really important that you consider, okay, here's all the potential options. Here's 3 or 4 that would meet my needs. Here's one that's maybe available that if I made some changes to our entity structure or our growth strategy, having as many of those exit doors available so that when that time comes, or there is an economic event, there's a personal health event, there's an environmental event in your industry, that you get to pick which door you're going to walk through versus being forced off a plank. I think that's something that is also sort of unappreciated about exit planning is when we talk about designing an exit, it's really about maximizing your options and maximizing your bottom line and meeting your, tangible and intangible goals of an exit, depending on which door you walk through. So so many analogies there. I think I've lost count at 5.
I was just thinking about walking the plank and I was like, so
Yeah.
everybody's just listening. You said some very insightful things, specifically when we talk about designing, the way you put yourself in a position, as you said, to not have to time the market is that you plan way in advance and put your business in a very good position. And one of the ways that you do that is make sure the business has strong financials. Make sure the business is well organized. Make sure that if you're the owner, that the business can run without you. Here's a quick way, if you're listening, if you're an owner and you own a business, if you can't go on a vacation without having to respond to an email, you don't have a business that can run without you. Okay. So that is an issue. That's a red flag right there. You probably need to really think about your business and putting people in place. You need to have processes. You need to have good agreements. You need to have, as Sarah said, you need to be prepared if somebody were to die or to get sick or disabled, or if there was a distress event like COVID. So you need to be financially prepared. And so the best way to put yourself in a position to maximize all these options that you've shared is to prepare in advance, so that you can then choose the option that best suits what you're trying to do and where your passion is at. Because as you said, the environment has shifted, right? We were in a
Constantly.
period of time where, let's call it from 2010 until last year, even though the markets were up. So capital partners, which you referenced, private equity, et cetera, were strong buyers of business. But as interest rates and markets shift, the deals change. And so, as I sit here thinking about this area, and you talked about your clients that you spoke with, it makes me think about just yesterday. I had a conversation with a guy who he took over an architecture firm from the owner who passed away suddenly. The owner didn't have any children, and so his succession plan before the owner passed away was, I'm going to sell to somebody who's been with me the entire time. So that's an example of selling to an employee. So when you think about these options, what do owners need to be doing, as you see, as they get closer to selling? What do they need to be doing, and when do they need to be doing it by, to take advantage of some of these options?
So I'll say my normal spiel. If you're starting a business tomorrow, you should start your exit plan tomorrow. That's not typically how it goes, but that's my advice, right? You need to run the business like you're planning to sell it. Run it for the next 30 years, pass it down to 4 generations in your family. As you said, from a business strategy perspective, there's not a lot of negative consequences to having a strong exit plan in place and running the business as though it's currently something that could be sold and could be traded for a tangible value. So what are some things that owners need to do? So I'll give you, that's my lofty goal, is that for every business that starts, a key part of the business plan and the growth strategy is an exit plan from day one. I know that's not realistic. If you are planning an exit, you can do a lot in a year. You can do a lot in 6 months, but you are going to be leaving a lot of money on the table, either from tax planning, kind of understanding the value drivers in your business, creating, those additional options, which may create better structure outcomes for you. So if you're thinking about selling your business in the next year and you haven't done any planning and you feel like you need to catch up and you're feeling hopeless, don't quite feel that way. There is a lot you can get done with a 12-month runway. Your options get pretty lean. The closer, the smaller, a year, a lot is doable. Ideally, if a client was coming to me and said, hey, I'm starting my path to exit, I've got maybe 5 years left in me to run this business, I'd say perfect. If you've got 4 to 5 years to really build and understand what that exit is going to look like for you, some especially for larger businesses, I have a point about kind of Main Street and kind of operator businesses I want to make, but for larger businesses, tax planning, entity structuring, really understanding what you want to happen with the proceeds of the sale. Like, what is your intent? Is your intent to start a new business? Is your intent to fund college plans for your kids? Is your grandkids? Is your plan to invest that money in, are you going to make charitable donations? All of those are right answers. It's just trying to make those decisions once the wire's transferred after the sale. You're really going to leave a lot on the table. So my lofty ideal answer is, please, let's start from day one. There's nothing bad will happen by having an exit plan in place. But if you don't have one in place, an ideal time frame is 3 to 5 years. But don't throw in the towel if you've only got a year out, or there's some other reason that you're exiting earlier and you don't have a plan. Get the right professionals in your corner. So that's kind of the second part, is what for me, I'm happy to help anyone. I'll have a conversation with anyone about kind of where they're at and what they need to do. But whether you're speaking with a certified exit planner like Eric, you're speaking with your, wealth or financial planner, even initiating that conversation with a CPA or some trusted advisor that's around you, starting somewhere is better than not starting at all. And beginning that process, whether you kind of approach it from the perspective of building a transferable business, a point you made about, can you take a vacation? Do you have that leadership team in place that allows the business to run without you? Do you have scalable systems and processes? Do you have clean books? Do you have documented operating procedures? Do you have some secret sauce about your business, a process, a way that you guys, your business really thrives? Particular client relationships, are those protected either contractually or with patents or trademarks? Those are all, again, if you want to start from the financial planning perspective, great, start there. If you want to kind of start from an IP and protecting what's special about your business, that's great too. So those are a few areas. I know that was a very long answer again.
No, I think that was spot on. But I was thinking, some things that aren't time frame as you were talking. And like, I agree with everything that you said. 3 to 5 years, ideal. You can do the most effective planning and really orchestrate stuff as opposed to being rushed. Because when you're rushed, you have to move too quickly and you don't have enough time to do your due diligence. So you may miss things along the way. But I was actually thinking, if you're an owner or you're talking to owners and you're listening to this, when your owner friends, or if you are an owner, when you wake up one morning and you're just not enjoying your business anymore, or you're feeling like there may be other things that you want to do, or it's Friday and you're having a cocktail in your hand and you're thinking, I wonder what it would be like to not be in this business. If you don't have an exit plan, when those thoughts start flowing through your brain, that is a critical self-reflection moment for you to start a conversation. The conversation could, as Sarah said, it could start with your financial advisor. It could start with your business attorney. It could start with your CPA. If you're strategic enough to have built a relationship with somebody like Sarah, where you're having these conversations beforehand about what are your exit options. The point is that check with yourself emotionally on where you are, because listen, your business, is an asset. It probably comprises 80+ % of your net worth if you're like most business owners. But outside of it being 80% of your net worth, one of the problems that owners have is it becomes 80 to 100% of their self-worth, right? It's how they see themselves, what they do every day. And so if you have those two issues where it's like, you got a lot of money and time, you got a lot of self-worth tied into this business, you need to have this conversation about what does life look like outside of the business. And I know, Sarah, that you're extremely passionate about that. So when you talk to owners and they're like, okay, I'm going to exit, what are the things that you tell them about after the exit?
Yeah, I mean, I think that there's a lot of, a big part of what I try to do is, number one, just kind of, demystify the entire process. My kind of entry point to this industry was my husband and I were going through some M&A activity ourselves. And I found it to be really frustrating that I couldn't kind of get the information that I needed. So when I'm talking to owners and we start to have that conversation, a lot of it is I say, okay, let's not worry about, what private equity firm, let's not talk about all of that. We're going to get there, right? But to the quote that you started this chat with, let's start with the end in mind. Let's really understand, what does success look like for you? We've, whatever your visualization, I don't want to get too touchy-feely, but, close your eyes and say, okay, I have exited the business. Describe for me what that's like. What are your goals, right? Tell me tangibly what that feels like. And, sometimes people will kind of make, I think, sort of, typical comments. Oh, I'm going to golf. I'm going to travel. Yes. Yes, you are. And I want that for you. And everybody needs vacation. And especially after what could be, 20, 30 years, making a lot of personal sacrifice to build a business, you deserve it. But most people really don't just that next Monday just spend all that time golfing. And as we end up working through a transaction, people have different drivers. Some are really interested in, long-term, legacy wealth that they want to pass down and preserve for their family. People have charitable giving requirements. A lot of, I would say, lower mid-market businesses, which is the majority of the transactions that I work on, typically 5 to 50 million in enterprise value. Those their employees are an extension of their family. And we spend a lot of time talking about what life is going to look like for those employees. There's definitely a very paternal, maternal relationship that can happen in these businesses where people really worry about, okay, is my team that's helped me build this company, are they going to have jobs? Are they going to have additional opportunity? How do I most efficiently share in this exit that we've all built together? I want to protect my end meaning, but I also I have a team that's worked with me. I'm working with a seller right now that's his number 2 concern. He has a number in mind that he wants out of the deal, but his second concern is not only how the employees are going to fare throughout the transaction, but what their future looks like, what opportunity is there for them. And, these are people that he's worked with for 20 years. He's been to their kids' weddings. He's, they've had families, all of that gets kind of tied into this decision. So if you have to really think about truly, what is it that you're looking for at the end of this transaction? And then let's work back. Can we accomplish those goals selling to private equity? Maybe private equity or family office is a great buyer. Maybe once we really understand what you're looking for, they're not. And so we need to kind of manage how we position you and how we prepare for, a non-private equity buyer. So there are so many paths to take. You just have to kind of figure out what you really want to look at. And I, early on in this journey for me in this profession, I was interviewing people who had been through the sale of their business. And I think about this all the time. This gentleman explained to me that selling his business was more traumatic than the loss of his parent. And I carry that with me in every conversation that I have with an owner. How do we get you the return on all this time, energy, investment? How do we accomplish all of your objectives? And how do we also limit that trauma? We don't want this to feel like an event that you mourn. We want this to be a celebration and a next chapter for you. So another very long answer, Eric. I'm the worst.
No, I love that because it makes me think about the most important thing that you do when you do exit planning is think about what do you want for yourself? What do you want for the people that you care about, which is typically your spouse, your family, your employees, the community if your business has expanded to have a positive impact, etc. And as you're thinking about these things, exit planning is about when you actually want to exit. So if you want to stay in your business, an exit for you could look like this. You bring in a key employee. I was talking to an owner that owns a construction company in Alaska. Okay. Booming company. He has 2 younger partners that are 20 years younger to him. His exit was, you know what? I'm just going to let these guys run things and I'm going to slowly start transitioning over more of the cash flow and profit to them. And then what I'm going to do is let them buy me out over a 5-year period. And he's been orchestrating this for 10 years. Okay. Some other folks' exits are I'm going to sit there and work until the end. And then when I'm done at my desk, somebody's going to take it over, either one of my employees or there's a key family member. But if you plan to exit prior to this, you better have a plan figured out for what you're going to do with your life after the fact, because there are so many stories. Sarah just alluded to this person saying it was traumatic. If every day you get up every morning for 10, 20, 30, 40 years, however long you build your business, and you're passionate about the work, and that becomes a part of who you are, right? Because the number one thing that folks ask is, oh, what do you do? Right? Well, if you sell your business and people are like, what do you do? And you don't have an answer, I got to think that's going to be emotionally challenging for you. So the number one thing that I see with owners that they don't do is they don't even think about, they would say, okay, you know what? I took care of my personal planning. I met with Sarah, my CPAs, my attorneys. I took care of the business aspects, the contracts, these things. They never think about what does it mean for them personally, right? Like, what am I going to do every day? Because traveling, golfing, all these things get boring because they don't give you any fulfillment, especially if you're used to working hard every day.
Right. Well, and people that own businesses are typically pretty type A and get a lot of personal satisfaction from, accomplishment and, creating the outcomes that what their business is producing, the service or solutions that they're, products that they're providing. Most people don't. Running a business is hard. People, it's not. If you're not passionate about it, it can be pretty difficult. So. It is important. And something you said kind of reminded me of a point earlier. I think building a business that is transferable and that you, again, an owner that can take a vacation. I had an interesting conversation recently with a medical practitioner that reminded me of a conversation with an attorney who had kind of a very interesting and very niche legal practice. And so those guys kind of will talk about, exit. There is no exit planning. Like, I'm the business. There's nothing to be done. Respectfully, I disagree, because an exit isn't always a sale. It's not always a transaction. And there's still a lot you can do, even if you do happen to be the main driver of a business. It's not what my firm specializes in, but there are still tools that you have. If you are running an operating business of any sort, there are items that you need to put in place rather than just, well, when I'm done, I'll shut the door, So, I think that's really important. Something else you said I kind of thought about too was you talked about it being like one of the largest assets that people have. I think another really important part, I am shocked how frequently people don't actually know what their business is worth. And the gross inaccuracies that they are often given, even from people within their kind of trusted advisor circle. My partner and I'm actually going to be putting some content out myself about this in the next few days, but we had a pretty wild valuation that really set an opinion in this seller's mind by their CPA. And that valuation was way off. And so a really important part of exit planning that I want to kind of change the conversation a little is around know what your business is worth, right? Talk to a valuation professional. Your CPA may be a good source, but typically the CPA that helps you file your business tax returns is not the person to help you really understand the value of your intellectual property and personal goodwill and some of these other concerns. But you should, from time to time, you should get a watermark on what your business is worth. There are different ways to value a business. But another big issue that I see is that people come with either no idea what their business is worth or a very wrong idea of what their business is worth. So if you're kind of going through life and you expect that your business is worth $20 million because your friend sold their business for, I'm trying not to roll my eyes, but I'm going to have to, if your friends sold their business for a 20x multiple with my, that is maybe not a reality for your business. There's a lot that goes into it. So some people may kind of put off and say, exit planning doesn't matter. I'm going to sell my business for $20 million. Well, what if your business is only worth $6 million? Does that change the equation for you? I hope.
Yeah, I would agree. I would agree with you wholeheartedly. Whoever is running around here, and I'm going to synthesize this because I know me and Sarah share this sentiment. Who's ever running around here talking about multiples to people about their business? Okay, great. That doesn't mean that's the multiple you're going to get. Multiples are ranges, and the things that drive your range have everything to do with exit planning, which is having a strong business, making yourself irrelevant, not having over concentration in one customer or one revenue line, or having absorbent expenses that you've done with the company, or not operating profitably compared to your peers. There's so many nuances that go into evaluation. And for somebody to be running around here as the multiple influencer, as I'm going to call it, in the age of social,
Yes,
in the age of social media, it's crazy. Stop telling people multiples, because just because somebody got X doesn't mean you're getting it. You might not have the same buyer. You may have that the buyer, for all you know, that bought that business at a higher multiple than what you're going to get, could have had 5 other businesses that created strategic synergies that created more value for them to do that. There's so many
right.
things there.
It's so many things. And I think what's also, I think, particularly harmful about the bad valuations is that they can be wrong in both directions, and it's really important to understand that valuation, here's my for people who've had extended conversations with me, you'll have heard this before, but valuation is part art, part science. There are the tangibles, like $1 million in EBITDA is $1 million in EBITDA. However, there is that kind of exactly what you're talking about. Do I want a $1 million EBITDA business that has 30 years of goodwill, has been growing, steady 2 to 3%, navigated the pandemic without much impact, or a really volatile 2-year-old EBITDA, $1 million EBITDA business? Which one? And they're in the same industry. Which one? Are they worth the same amount? I'm not even going to tell you that one's worth more than the other, because we just don't know enough, right? Like maybe this business is operating at, twice the, margins. They're producing that at a much higher scalability than this kind of other business. Maybe there's a special contract or relationship. So there are a lot of people running with scissors on valuation. And especially when you talk about intellectual property, brand, personal goodwill, customer lists, assets, inventory. $2 million of inventory is that inventory at cost? Is that COGS? Is it all sellable? What's inventory turns? There's so many things that can go into it. And it's really important, I think, from whatever your plan is for exit, for business owners to get evaluation. I'm going to probably, people are going to come for me in the comments, I think, and I'm ready for you. These online valuation tools, I see industry professionals incorrectly calculate EBITDA earnings or incorrectly forecast a discounted cash flow. A business owner or someone that is not familiar with these kind of financial principles and is not savvy and is not certified to do that, I just don't know how you would even enter let's say that these tools do provide accurate multiples and have some way to factor in these intangibles. I don't think that's true, but let me, make a concession that they do. Um, I see industry people who are, CPAs and M&A professionals and brokers. I see them make errors in those calculations. It's really damaging to have an owner that's not familiar with those ideas and how to do that properly, filling out a web form to come up with a valuation. It's either going to produce a valuation that's way inflated, and you're going to have what I call a 52-week high illness. You saw a number that was, very, very high, and it's going to be hard to kind of talk you out of that. Or, you may be kind of leaving a lot of money on the table because the business isn't valued properly. So a key part of exit planning is you got to know what you have. And especially if this is 60, 70, 80% of your assets, and this is something that is your whole retirement, you should know what it's worth.
And I'm going to add on to what you're saying too. I think there's another disconnect that I see too, is that, we would encourage you to work with somebody that's a certified valuator, or somebody that's going to do something that's not cookie cutter, like Sarah talked about. The internet's a beautiful thing. Artificial intelligence is a beautiful thing, but you don't want that for your valuation. Here's the other thing. Even if you go and work with a CVA or somebody that's a certified valuator and they give you a valuation, that still doesn't mean that the valuation is right, because here's the reality. The valuation is, what is a buyer willing to pay you for your business? And the value and the buyer may see something different than what the valuator saw because of market conditions, capital, interest rates, a multitude of other factors. So I know, Sarah, that's where you're coming from too, in the capacity that the thing is that if you don't have anything, go out and hire a professional to give you a valuation, and do that every couple of years, even if you're not
Yes.
going to exit for a while, if for nothing, to see your own progress, right? Hey, I
Yes.
started here and I drove EBITDA here, and I made these changes in my structure and my people. And as a result of doing that, I added $1, $2, $3, $4, $5 million in enterprise value to my business. Who doesn't want to know the score, especially when your time, your money, your attention and intention is flowing into this thing, aka your
Absolutely.
business?
Absolutely. And it's really important. I like the point that you made about, and what I tell people all the time is, listen, you get what you pay for. I I will provide people a kind of watermark on valuation. It is not, I say it 10 times. You can't take this to the bank or to the IRS. It's just my opinion from my chair, and that's why you're getting it for free, complimentary. Um, but I want people to know what their business is worth, and more importantly, that conversation, exactly what you said, it almost always produces, uh, it almost, to me, it's a great way to kind of start to have this conversation, whether people decide to work with me or not. I want you to work with someone. I want you to work. It's a one time, for a lot of people, it's a one-time event. You need to work with the advisor that is the best fit for you and your outcomes. But I'll talk to anyone about getting, an understanding of what your valuation is. We can't improve what we aren't measuring. So to your point, you can really, I look at P&L statements and I look at a wide range of businesses. So when I kind of go through evaluation, I also say, hey, I think your insurance costs are really high. Is there something that's driving that? That's something that you might want to talk to someone about. I think maybe, and they're like, oh no, my friend's taking care of us. He's done our insurance for the past 10 years. Okay, I think it might be still work with your friend. I think you need to, take a look at these costs. That's really impacting your bottom line. And the other important piece about getting evaluation from time to time, for large businesses, let's say your exit's going to be 20, 30, 40, 100 million. This advice maybe isn't for you. Those businesses are often valued a little bit differently. But for, lower market transactions, under 25 million enterprise value, there are multiple ways to value a business, including, looking at a discounted cash flow and future projections and some of these intangibles. But a lot of the valuation and a lot of the value in the business is also a look backwards of the past 3 years. So if you get a valuation in 2023, and whether it's me or someone on your team, Eric, or an exit planner or a certified valuation professional, and they say, hey, here's where you are, typically that valuation is also going to provide some information about, you've got some, I think there was a comment, hey, we're having a hard time valuing your business because there's some inconsistencies in your bookkeeping. We're having a hard time kind of mapping what your true CapEx costs are because CapEx is kind of flowing through your P&Ls. If that valuation exercise not only is going to give you a directional range of what you could expect for an exit, it's going to tell you a ton about how you can increase the value of your business, what those areas are in your business that may be pulling your value down. And it's also a great opportunity to see what else is going on in the market industry. What are that you're operating at 15% EBITDA. What are other players in your space? Is that above or below the industry? Or is everybody else at 20? Or is everybody else at 10? Those are things that you can learn from evaluation that, in my opinion, as part of exit planning, are way more important than my business is worth $6.5 million.
Yeah, I think that this valuation component is a key part of exit planning in general. Let's just thinking about it this way. There's three things, and Sarah, you kind of talked about it. To me, there's profit gap, meaning how, you talked about it. We frame it this way through exit planning. Profit gap. What is the gap in your profit compared to people who are best in class? As a result of your profit, right, and where you fall in the range, what's your valuation gap based on somebody that's a best in player? And then the one element that misses from that is, what is your wealth gap? I can't tell you how many owners have come to us when we look at exit planning or helping them with their wealth side of this equation. And they're like, I got a letter of intent, or LOI, for those of you that know. I want to make sure I spelled it out. Is for a number, 10 million, 15 million, 20 million. How in the hell do you know if that's the right number? And the only way you know that is if you've done some planning to say, what is it that I want for myself and my family after this exit, to know that the valuation I'm getting, the value, the offer I'm getting, and if I exit, is the right number for me and what I want to be able to do with my life. And the answer may very well be, okay, great, that's more than enough. Or the answer may be, hey, this number is not high enough. And if it's not high enough, you need to ask yourself why. And either you're going to adjust your lifestyle that you're going to have and take the number, and you're going to move on. You're going to end up doing something different, and you're going to live a lesser lifestyle. Or you need to go back and make some adjustments to your business to get the valuation where it needs to be. Or you need to save more personally outside the business and invest for your future and your retirement so that you could be okay with that number. And I think that gets missed a lot with valuation, is really understanding where this business fits in the ecosystem of the owner or the owner's overall financial well-being.
Yep. And another great point that you've brought up around, these organic offers, I've gotten, a couple of times I've had people call and they'll say, well, we've got an LOI. We don't really need to retain your firm, but, we just want you to look at this LOI and tell us if it's a good LOI. And, I want to be helpful. And some say, okay, sure. No problem. Happy to do it, But what I've discovered is, one, most people really aren't equipped to truly even understand what are you going to receive from that $20 million LOI, a very real thing that I'm navigating in the past couple of weeks. I have a business I've been working with. We were really preparing them for acquisitions of their own. And in short order, we've received, let's say, we'll just, for purposes of this discussion, 3 offers, LOIs, they are all in the range of one offer was 5.25 million, one was 6.8 million, and one was 6.95 million. What I think should illustrate the difference in, number one, kind of deal structuring and who your buyer is, and also how important tax planning is that the $5.25 million offer actually put more cash in the owner's pocket at the close of the transaction than the $6.8 million offer. So if there's that kind of delta between 5.25 and 6.8, think about the continued complexities with a $10 million offer, a $20 million offer, and how much of that is in rollover stock and earnout, and is it an asset sale? Is it a stock sale? Are you prepared for, are you eligible for a 1202 deduction? Are you, do you have access to, can you orchestrate an F reorg? These are all things that probably sound complex, and I'm not trying to make them sound complex, but it's super important to understand. Let's say you're going to do a $10 million offer. You're going to sell your business you get a valuation and it's $10 million. Okay, how do we get as much of that $10 million in your pocket as possible? And maybe you could be happy with an $8 million offer if it's structured better, right? So these are the conversations that people need to have, and why I really advocate for exit planning well in advance is we can start to understand what is in your arc of happiness and how to really, again, design your exit, understand what you need from a bottom line perspective for your long-term, wealth structure, like you said. So it's really, really critical. And if you don't do it, you can legitimately leave millions of dollars on the table, even at a deal size of, $5.5 to $6 million. It makes a huge difference.
I think as you were sitting here talking, the concept that was running through my mind loudly was, if you're advising owners and you're listening to this, or you are an owner, the biggest problem I see with companies in this lower to middle market, I call it SMID, small and mid, the smaller end of the mid, it's that they could learn from companies that are bigger, is the owner should have a board of directors or a team, right? Exit planning is a team sport. This is not a solo deal. The financial advisor, the business attorney, the CPA, the M&A person, the family members, no one person can help the owner win the game to get a better outcome for them and the people that they care about. So this is a team sport. So exit planning is a process. Exit planning is a team sport. And it's super important that all of the team members are playing together. And it looks like some of the things that got shared in some of our comments were around valuation, benchmarking, false sales. So Sarah, how many companies do you talk to that don't exit or want to sell but don't sell? What do those scenarios look like? How many people approach you and like, hey, I'm thinking about selling, but they don't have a sellable business?
A lot, right? A significant portion. I mean, I think I would say from the people that I talk to, that statistic of about 10% have some sort of exit plan in place. That's probably about right. I speak to a lot of owners, and some key issues we have if the business is not sellable is either sellers' expectations can't be met. That's a big one. Is somebody told them they should expect 5x revenue, and it's a small Main Street business. And while I won't, I try not to speak in, absolutes, like while there may be some Main Street businesses that can sell for 5x revenue, generally that is not the case. And I I can't help that person because their expectation is, if they're firm in that expectation, I'd love to talk to the M&A person that gets them that result. But I think there was a comment about 2 out of 10 businesses that want to sell actually sell. That is an industry statistic that is pretty depressing. And for me, the businesses that have the transactions that have gone well and where there's been a very strong outcome have been when there is a plan in place and that person has the right team around them. And we get, we'll just pick on attorneys, right? Or I'll pick on myself. Sometimes an owner can sort of bristle at the fees for, someone like myself or an attorney or a wealth planner or financial advisor. But let's say you even spend, on a $10 million transaction, let's say you end up with legal fees and everything, you end up spending, $500,000, right? If it got you an extra $2 million in your pocket, isn't that a good value? So understanding getting the right size team around you. If you're selling $1 million business, you probably don't need, a big M&A attorney from Culhane. Nobody from Culhane. You guys are very great. Don't come for me. But get right size support, but get the team around you. If you want to be on the right side of that statistic, if you want to be one of the 2 out of the 10. Get your exit plan in place and get the right team around you that can help you navigate this complexity. Otherwise, there's a lot of people that are on the wrong end of that statistic. And I don't know this to be fact. It's just an opinion, but probably half of them is because of a failure to plan and failure to prepare.
I couldn't agree with you more. So we're getting close to the end. I just want to recap a couple of things that Sarah and I have shared. Exit planning is good business strategy and it's a process. Exit planning is a team sport. So advisors need to all work together in concert for the owners that they're advocating. Some of the options laid out simply are I can transfer or exit to a family member. I could transfer or exit to a key employee. I could sell to a third party. I could shut down. And one of the things that you brought up, Sarah, was I could take some chips off the table and get a partner. There's this whole concept of taking a second bite of the apple, which is I bring in a partner who lets me get some liquidity so I can diversify out of the business. They help the business grow. We exit in the future. And now I still have a piece that ends up being as large as when I exited the first time or significantly higher. So exit planning is a team sport. It's a process, not an event. And we want to be a resource for you, all of you that are listening. Please feel free to comment in the chat. Sarah and I will both be working this. If you're listening this on LinkedIn, I'll make sure Sarah has the YouTube channel as well. We will be putting this out, and comment on other topics you want us to discuss. Comment us on things that you want us to uncover and share with you insights. So I want to thank everybody for joining Sarah and I. It was a lot of fun having this conversation because business owners are some of the most important people in our society. They drive job growth. They drive innovation. They drive capital. They help grow communities, and we are advocating for you. It's better to have a plan that you don't follow than have no plan at all. So please, please, please have a plan. Thank you.
Thank you so much, Eric.
Thank you, Sarah. See you, everyone.